Two neighbors, same income, same retirement accounts. One pays $174.80 a month for Medicare. The other pays $447.10. That is nearly $3,300 a year more for the exact same coverage. The difference was not wealth, it was not luck, and it was not a mistake on a form somewhere. It came down to one income decision made at age 63, 2 full years before either neighbor ever touched Medicare. Quick note before we dig in, this is general education about how these rules work, not personalized advice for your specific situation. Picture Richard. He retired at 62 with about $600,000 in a traditional IRA, feeling calm and ready. His advisor suggested Roth conversions during the low-income gap years before Medicare, which is standard, well-respected advice in most retirement planning circles. Richard converted roughly $90,000 a year for 2 years. Every move was approved, modeled, and blessed by a professional he trusted. Then, at 65, his first Medicare premium letter arrived in the mailbox. It was not the standard rate. And Richard had no idea why. Hold that mystery for a minute because the answer is the whole point of this video. Here's the rule almost nobody explains clearly. Medicare does not look at the income you are earning right now to price your Part B premium. Instead, the Social Security Administration reaches back 2 full tax years into your past. The premium you pay at age 65 is set by the income reported on your tax return at age 63. That single mechanic is called the 2-year lookback, and it is why age 63 quietly becomes one of the most consequential tax years of your entire retirement. Now, to be fair, age 63 is not the only age that matters in retirement planning. Age 59.5 unlocks penalty-free access to retirement accounts for most people. Age 73 or 75, depending on your birth year, is when required minimum distributions kick in and force income whether you want it or not. So any honest take has to admit 63 is not magic on its own. What makes 63 different is that you usually still have real control over your income that year, and the decisions you make will directly price something you cannot opt out of later. That something is called IRMAA, which stands for Income-Related Monthly Adjustment Amount. And you need to understand one critical feature of how it works. IRMAA is not a gradient that slides up smoothly as your income rises. It is a cliff. One single dollar over a threshold pushes you into the next full tier, and your monthly premium jumps immediately by a large step, not a tiny nudge. Let me show you the 2026 numbers so this feels real in actual dollars. The standard Part B premium is $174.80 a month, which is what most people end up paying for the year. Once your income crosses $109,000 as a single filer or $218,000 as a married couple filing jointly, you jump to $284.10 a month per person for the whole year. Cross $136,000 single or $272,000 joint, and it jumps to $365.60 a month per person every month. Cross $163,000 single or $326,000 joint, and you are at $447.10 a month per person for a full year. Above $195,000 single or $390,000 joint, the number is $528.60 a month per person every month. And at the very top, above $500,000 single or $750,000 joint, you are paying $689.90 a month per person for the entire year. Let that top number sink in for a second. A married couple in the highest IRMAA tier pays over $16,500 per year just for Part B, compared to under $5,000 a year for a couple sitting just below the first threshold. Same Medicare, same doctors, same coverage, radically different price tag. Now you see why the cliff mechanic matters so much. Let me make this concrete with a single filer scenario so you can picture it happening. Meet Linda, age 63, retiring next year and sitting on a traditional IRA. Her advisor runs the numbers and suggests a Roth conversion of $120,000 to use up a lower tax bracket while she still can. Her modified adjusted gross income for that year lands around $139,000, which sounds fine at first glance. But that number sits inside the second IRMAA tier for a single filer, which means at age 65, her monthly premium becomes $365.60 a month instead of the standard rate. That difference costs her roughly $2,300 extra across a full year of premiums for a single decision. Now a married couple, because this trap does not only catch Roth conversions. Picture a couple, both 63, with a few different income streams happening in the same calendar year. He takes a consulting contract worth $40,000, she sells some long-held appreciated stock, and together they pull a modest IRA distribution to cover a home repair they have been delaying for years. None of those moves feels extravagant individually, and each one has a clean financial reason behind it. But stacked together in one tax year, their combined modified adjusted gross income pushes them across a joint IRMAA threshold they did not even realize existed. 2 years later, when Medicare arrives, their combined premium is thousands of dollars a year higher than it would have been. Now you might be thinking, wait, should I just never do Roth conversions at 63 then? That would be the wrong takeaway, and I want to be careful here. Roth conversions can be genuinely powerful for long-term tax planning, especially for people whose later required minimum distributions will be uncomfortably large. The standard advice to convert during low-income years before Medicare is not wrong. It just becomes incomplete at age 63 if the conversion is sized without accounting for the 2-year look-back pricing Medicare 2 years later. So who does this actually affect in the real world? If your income is consistently low and there are no large discretionary events on your horizon, you are probably not walking into the IRMAA cliff by accident. But if you own a traditional IRA, a 401k, appreciated stock in a brokerage account, rental property, or a business you can sell, then you have control over the timing of your income. And that control is exactly what creates both the risk and the opportunity here, because everything you can choose to trigger, you can also choose to postpone or split. Here's the part where you get to act. Your situation will differ, so think of these as starting points, not a plan. If you are 60 or 61, this is your maximum flexibility window. Run Roth conversion projections now, while the look-back clock for age 65 has not yet started ticking for you. If you are 62, this is your last full year of breathing room before the look-back window opens. So map out what December 31st actually looks like before you sign anything. If you are 63 right now, the decisions between today and year-end are directly setting what you pay at 65. So you need to know your modified adjusted gross income and your threshold with surgical precision. If you are 64, the look-back window for your 66 premium is already filling in. So review what happened at 62 and plan carefully for what is about to be priced. And if you are already on Medicare and got hit with a surprise premium, there is still a path forward. Here is your screwdriver moment, the one thing you can do in the next hour. Pull up your most recent Form 1040, find line 11, which is your adjusted gross income, and compare that number to the $109,000 single threshold or the $218,000 joint threshold we just covered. If you are within $20,000 of the first threshold and you are anywhere between 60 and 64 years old, it is time to run the full numbers carefully before year-end arrives. If a one-time life event already pushed you across a threshold, look up Form SSA-44. It is the official Medicare Income-Related Monthly Adjustment Amount Appeal Request form. Qualifying life-changing events on that form include retirement, reduction in work hours, marriage, divorce, death of a spouse, loss of income-producing property, and loss of pension income. The appeal lets Social Security use your more recent income data instead of that old 2-year-old tax return that is driving the surcharge right now. And for those already in retirement with consistent IRMAA exposure from required minimum distributions, a qualified charitable distribution from an IRA goes directly to charity and is excluded from modified adjusted gross income entirely, which means it does not count toward any IRMAA threshold anywhere on the scale. One more piece worth knowing because it catches people off guard in the hardest possible moment. When a spouse passes away, the surviving spouse eventually files as single rather than married, filing jointly. The same household income that sat comfortably below the $218,000 joint threshold can suddenly exceed the $109,000 single threshold the very next tax year. Roth assets inherited by a surviving spouse provide tax-free income that does not count toward modified adjusted gross income at all, which is why conversions done thoughtfully in the gap years are, in a real sense, a gift to whichever spouse outlives the other one. So let me close Richard's loop for you. Richard did get hit with an elevated IRMAA premium at 65, and it was real money out of his pocket. But it was also temporary. Once the look-back rolled forward to a year with lower reported income, his premium dropped back down to a much more reasonable level. The charge was real, yes, but it was also entirely avoidable with slightly different timing. He genuinely did the right thing at the wrong age, in the wrong calendar year. Before you act on any of this, talk to a financial advisor or CPA who understands your full income picture. Because a short video cannot see the details that will actually determine what you owe. So quick question for the comments below. Did you know about the 2-year IRMAA look back before today? Or is this the first time anyone has walked you through how it actually prices your Medicare? And if you are already on Medicare, were you surprised by what your very first premium letter said? If this cleared up something real for you, that little like button is genuinely how I know which videos to make more of. And if you know someone in their early 60s sitting on a traditional IRA or a 401k, send this to them before they make an income move this year. Because here is where this conversation goes next. We just spent a lot of time on what Medicare costs at different income levels, but almost none on whether the retirement savings targets pushing those incomes are even accurate for most Americans. You have probably heard that the finish line is $1 million saved, or something in that neighborhood. The actual federal data on what households have saved tells a very different story, and it changes what retirement readiness really looks like for people who are not sitting on those headline numbers. That is exactly what the next video breaks down, so I will see you there.